Okay, then we'll get going. So I have my standard disclosure notes and see if we can get this thing moving. Okay, so at the start of the year, the US had strong growth, full employment, and inflation trending towards target, while China had weak growth, high youth unemployment, and deflation, mainly based on the fact that they have too much savings and too little spending. And just to put it in perspective, China's, as a percent of global savings, is 28% of global savings rates today. If you combine the US and the EU, it's 33% of global savings. So the excessive high savings rate is due in part to the lack of social safety nets, which means that it's very hard for them to get the consumer side of their economy going. So when we started the trade war, the tariff war with them, that really took away two of their best markets, one of their best markets, and put their second best market in a challenging spot. So the US and China needed to take steps to de-escalate the trade war. And this past weekend, they found an off-ramp by going to Switzerland and have now lowered, or in the process of lowering, the rates from 125 and 145% down to something a little bit more reasonable. Today, I just want to talk about some of the potential positives for the market. We touched on a couple of these last week. I want to discuss the markets and whether you should go global or stay home in the US, and touch on safe haven assets a bit, and then talk about where I think things are going. What's interesting with this de-escalation, the odds of a recession have been coming down considerably after popping up a bit in the last couple of weeks. But let's go back to last week's briefing. I closed with, I think there were 5 things that were positives that were being overlooked because of all the negatives around trade. But I thought the US and China could work to ease trade tensions, and we are now in a 90-day de-escalation. I thought while manufacturing renaissance had taken a hit the last couple of years, it was going to start to reaccelerate. And I think whether it's the trade negotiations, whether it's just businesses in the US bring business back to the US, we are seeing a manufacturing renaissance reaccelerate after what was about a 3-year period where it was kind of on the sidelines. You now have this House and the Senate working on a big, beautiful tax plan. How that works and how we pay for that, a lot of work needs to be done, but it looks like there'll be some form of an extension and some more tax breaks coming. You have the deregulation effort going on, which was about 6% of GDP under the Biden administration. So reducing regulation and doing it in a smart way that you don't create new problems is a big positive for corporations, particularly mid-cap and larger cap companies. And then the other big fear that was holding back the markets was the big tech and their spending trends, and the earnings and results have proven that they're still supportive of the trends for the time being. So more positives, and what a difference a week makes from the mood around the economy. But I titled this de-escalation for now because it's all about the 90-day window and can people back what their commitments are going to be. So let's take a look at what some of the other impacts are. So this is the AII bull bear study, and it basically, the top was for the week ending April 7th, May 7th, and you can see 51% bearish, which if you go to the historical average is 30%, 31%. And if you look at the 1-year high, it was 62% roughly. So we're still at a pretty elevated bearishness in the markets. And I think from my perspective, this is somewhat of a positive that everyone is so negative right now. It doesn't take much to move the markets in a more positive direction, as we saw this week with the big moves yesterday. But first we escalate, then we start to de-escalate. Now everyone's wondering what happens next. And if you go back to previous deals, we really didn't see a lot of follow through on them by either the administration in the US or by China the last time around. But this is what the ride of the S&P has looked like. And we're back to, basically where we were when Trump was elected. So we've gone through a lot of gyrations for not a lot of benefit, but let's see where we go from here. One of the things that's been happening is companies did take advantage of the pullback in the markets to really ramp up their buybacks. And this is what you would hope to see is on pullbacks, companies get more aggressive. You just hope that the companies doing this have the financial wherewithal to deal with their debt and other issues, particularly if you see trade tightening up and other issues coming to the fore. But just for perspective, this is a comparison of the US equity market relative to the rest of the world on the left side in the MSCI weighting. And the right side is the share of global GDP. And you can see there should have been a move away from the US with 63% of the market weight and only 26% of global GDP. But it does speak to the size and scale of the US companies and the robustness of the US capital market system. And I think this is something that people underappreciate when they talk about safe haven status. But I would expect that while there's been a lot of push to move away from the US, I think we'll get better balance with some selective opportunities in the rest of the world. But I would be cautious about getting too aggressive to move away too far from the US weighting. So this just gives you a good perspective on what the world weighting is, what the GDP is, and you should try and be somewhere closer to these numbers than probably what a lot of people are. And I just think this is a kind of a better balance for people. What I would say, though, is when everyone was focused on the problems of the US with our trade and self-afflicted trade war that we started, the fact that we were going to get hurt, I think people underestimated the damage done to the rest of the world. When there was a big shift to move away from the US, you were moving to economies that were getting hurt by the trade issues. And we go back to it at the start of the year. China had weak growth and was spiraling towards deflation. Europe was barely growing at 0.2%, or they got as high as about 0.8% for the EU. And now it's kind of around there again. So not a great exceptional growth from some of these other areas either, which is why I think people got too negative on moving away from the US. So I'd just be cautious about how aggressive you get chasing other markets right now. The other issue that's been high on people's minds is the US still a safe haven market? And what about the sale of treasuries from China and other areas? And I think this is a real issue that people have to keep in mind, because the behaviors of the US have been so different from most of the post-World War II period that people don't know if you can rely on the US to be the upholder of the values of the post-World War II period. What I would point out here is we lose sight of the scale of the markets in the US compared to other economies. I go back to the previous slide. Look at the share of the US equity weightings compared to other weightings on the left-hand side, scale of US GDP to other countries on the right-hand side, and then look at just treasuries compared to other safe haven assets here. It is more than 2 times gold. It is more than 3 times Japanese bonds, gilts, bonds. They can't compete in the size and scale of the market. So when you go beyond the treasury market, one of the things China was doing was moving away from treasuries and buying mortgage-backed securities from Fannie and Freddie, because they thought there might be an arbitrage there as the government was moving away from them. So I would be careful about running too far away from the US as a safe haven and running too far away from the equity markets with what's gone on in this period. So it's something just to keep in mind. It's easy to say they're going to sell all this stuff and no problem, but they have to find a place to go to. And it's very difficult to see an economy that is as robust and as resilient as the US is. And I think that issue gets underweighted because of the politics that are going on today. So I'd just say be cautious about running away from the US and running away from treasuries, and be cautious about where you're running to, because there's some challenges in those other areas as well. So switching gears now, another hot topic is what's happening to central banks, particularly with the Fed. Chair Powell has been under fire from the president for some time for being too slow, too this, too that. I am not in that camp. I think Powell has had a very difficult job, had challenges with how to navigate the excessive fiscal stimulus on top of the excessive monetary stimulus. And how do you do that in a very interconnected world with policies that are completely unusual? And you can see that the odds of a rate cut are being brought in considerably. I've been on the camp for higher for longer. Our firm has for some time. I thought the market's been wrong since last September on rate cuts. I think what will happen is we're at a range, I think, on the 10-year that is a fairly reasonable level for where the US economy is relative to other countries. So I think Powell's right in not being too aggressive. I think the president would like to see him cut faster to offset some of the challenges being created by the tariffs. But I don't think it would necessarily work because I don't think the cutting rates will affect the trade issues that are slowing the economy down. I think it just puts a greater burden on the consumer. And if you cut too fast, it will stimulate inflation. And as I said, we came into the year with strong growth, full employment, and reasonable inflation numbers trending towards target. And I don't think the Fed's going to cut aggressively until they see unemployment moving towards 4.5%. Unless something else goes on in the rest of the world that's going to get us off kilter. I think the Bank of England is in a different spot. They recently announced a cut, and they may cut again. I think you have to see they're not in the best spot. ECB has cut 7 out of the last 8 meetings and likely to cut again. I think they have some growth issues that they have to work through. Plus, they need to stimulate their economy a little bit better to get it moving. I think Europe is in a very difficult spot because of their primary industries are under attack, and they're getting somewhat cut off from the US market due to the trade war. And now China is looking to dump more of their manufactured goods on the rest of the world. And the Euro area is one of the places that they're going to be targeting to dump. And that's going to put even greater strains on Europe. So I think this is going to be a very difficult one to get a negotiation for the US and Europe. I think Europe's going to have a tough time negotiating with China right now as well. I think they're in a difficult spot that they're going to have to get the act together to get the spends that they're trying to do to stimulate the economy. And they're going to have to figure out a way to work more closely together through this period. So the estimates have changed considerably this week. You saw recession numbers coming down from 40–50% or higher, coming back down now to 30. In some cases, Ed Yardeni just lowered his his recession estimate to 25%. He started the year out with 7,000 target on the S&P, pulled that back into 5,500. And today has raised it back up to 6,500 for his target on the S&P, seeing 300 in earnings and 21.5 times multiple roughly on the S&P returns. This was done from a chart from last week, 2 weeks ago, 417. The Wells Fargo guy at the time had the single highest target at 7,000. The rest of the street was at 6,037. I think you're going to start to see those numbers all start to move up. I think you'll see the recession odds continue to come down. But I also think this is a time to be careful about how aggressive you are moving into the market if you've been out. And the reason is, as we move forward, there are a lot of deal or no deal opportunities that we have to keep in mind. The US and China trade is a long way from finished. We just had an initial meeting that dialed down the noise, but we don't have anything close to a deal. We just have an easing of the tensions. The US has to get a deal with 17 other nations. They're talking about South Korea and Japan as important ones next up. Bessent was out saying today that he thinks that Europe is going to be a tough slog. I think that's right. You have the House and the Senate Republicans trying to figure out a tax plan for the president that's going to be very difficult for them. And when you get into some third rail items, it just shows you how much things have changed in US politics. The Republicans are talking about tax hikes on the wealthy, and even going after some areas of Medicare. This is a big change that's going on. I think other deals on 3 peace deals with Russia, Ukraine, Israel, and Hamas, and now we have the flare up with what's going on in India and Pakistan, which is the last thing the world needs is another conflict. And then we're trying to create a deal with the U.S. and Iran on nuclear. So there's a lot of things that can go wrong in an economy that's starting to try and get past some of the self-inflicted wounds created by the trade wars. I think this is a time to be balanced about where you're moving, to not panic, and to definitely take a longer term view. And for us, we're still investing in the areas of required spending, and we've taken advantage of some of the pullbacks to upgrade the quality. When you get a chance to buy some of the best companies in the world at significantly discounted prices, you got to jump on it. But we are moving back to where the multiples are a little bit rich again all over. And I think that's just something that you really have to focus on investing for need. So Mark, I'm going to stop there and open it up for discussion.
Thank you, Stephen. So questions, comments? No questions, no comments?
Brilliant as usual, Burke.
Sorry, go ahead.
You have a question, Michael, or just a brilliant comment?
Just a comment.
Okay.
Thank
Go
you,
ahead,
Michael. Keep coming back. I need that.
Roger, you got a comment?
Well, comment slash question. Stephen, if you look at the S&P, at least the multiple over like 100 years, it's typically averages around on 15. Since the 80s or so, or the 90s, it's been significantly elevated in terms of an average over the last 40 years or so. So you mentioned about S&P still being rich at 21. Do you think there's a new normal? Everybody talks about it, but do you think there's a new normal of what the S&P average should be?
No, I think the S&P average multiple is a reflection of the shifting of the economy. And really, when you think back to the time frame you just mentioned, was the start of one of the biggest tech revolutions the world's ever seen. And the US has dominated that in terms of companies in the public markets. And if you look at this is the argument between the US and Europe being so much cheaper than the US. It's the constituents that make up the index. And in the US case, when tech is 25% roughly, they're going to carry higher multiples because they're much higher growth. So I think it's a reflection of not a new paradigm, but just the ebbs and flows of what drives the economy, which gets reflected in the index. So I do think having a higher level, Roger, is appropriate given the shift inside the constituents.
I think there's another fact as well. I just think there's just more money in the system. The equification of the US markets have just gone crazy the last several years. So if there's more money chasing, let's say, fixed number of companies, by definition, you're going to have a kind of, I don't want to say an asset bubble, but you're going to have those prices be naturally pushed up. So I think that's another fact I've seen.
I'll throw a third one in for you, which is the Wilshire 5,000 is now 3,600 names in it. So I would believe, Roger, that the law of averages would mean the weaker multiple companies go out when you start to see them fall by the wayside.
Or the other way to put it, there are less companies that there's been a drop of the number of public companies that people prefer to be private. The only reason to go public is really for liquidity. So with less public companies out there and the same amount of money going into the market, by definition, you're going to have increased prices.
Yes, the structure of the market's changed.
Let's keep it going, if we could. Giovanni?
I gotta say, I've never really thought about it before, but I can't tell if you're a sort of conservative or liberal in the sense that you were cautioning against sort of going against, there was too much flight away from America and the equities. Are you saying now that that you think the fear of a the rest of the world selling off US treasuries, that's overblown, the sort of conservative fear that America's vulnerable because of its deficits and so on and so forth. Is that fear overblown in your opinion?
The deficit and debt issue is not overblown. The fear of money flowing away from the US and never coming back, I think is. I think I think it's very difficult to find enough places to move a lot of capital away from the US in scale. So I don't think the dollar I think the dollar will get chipped away, but I don't think there's any big change coming to the dollar. I don't think it behooves Japan or China to aggressively sell. And I think that what you see with the US Treasury is slightly higher rates, people will continue to buy it. So I think if it goes up too much too fast, then you won't. But I don't think we have trouble attracting capital. And I think that the fears of the spending or the view that the increased spending of Europe was going to divert a lot of capital away, I think that's overblown. So I would just say be careful about running away from the US because you think our problems are greater than the rest of the world. So I think you'd be running to other problems as well. So I think it's a combination of those, Giovanni.
So if the consequences of our deficits is foreign ownership of our debt, if that's overblown, then what is the consequences, especially given that we're getting into a budget which is going to go off the charts with debt because of tax cuts and spending increases. So what is the consequences of our deficits if it's not treasuries?
I think the way I would look at it is a little different. I think we will have a problem if we don't start to take the steps to get our deficits in under some reasonable level of order. But I think we're saying maybe two different things. I don't think that alone is enough to force people to run to other countries' economies to put your money into their treasuries or their bunds or whatever, because I think their problems are equal to ours, if not greater. So
Let's keep it going.
That's the challenge.
Bill Deichler.
Okay, thank you.
Yeah. It's been interesting to see the U.S. has narrowed the gap. I just took a look, as of close yesterday, where S&P is almost flat on the year, and EFA is still up about 5%, but that's the spread there is a whole lot less than what it was earlier on. So I'm wondering if it was somewhat of a head fake and investor knee-jerk reaction, which not surprisingly, given the way that Trump behaves, everybody kind of freaks out, and you have to take more of a long view on that. So
I think that's probably right. I think there's a lot of overreactions going on just because I saw an interview of the president the other day, and they were asking him a lot of questions, and I think his own policies were starting to confuse him. And he kept referring to, you have to talk to the attorneys about that, or because they've thrown so many policies at the market, it was designed to overwhelm. And I think it is overwhelming. And people have to step back and sort through that. So I think, Bill, it has been a little bit too much for people.
yeah. Oh, if I could just add, Leslie just put a comment in there that it's flat in US dollar terms, but certainly down in euro terms. And I was just looking at DXY, and yeah, we're down. Certainly like 110 was about the peak earlier in the last 12 months. But there's been sort of a reversal of trend since kind of late April, and we're about 101 right now. So we'll see. I think further good news could possibly trigger more dollar strengthening. I don't think necessarily we're going to get back to 110, but nonetheless, I don't think we're going to be cratering either. So I'll pass the baton.
We came in the year, Bill, with a really strong dollar.
Yeah, so true. So true.
Some of this stuff is just the natural things go too far one way. They need to consolidate. They need to reset a little bit.
Yeah.
So.
And Anthony Gordon.
Hi. It's a question. Good morning. What I heard could you just clarify if I heard what I heard correctly? It seemed to me like a radical departure from your sentiment in that for the first time, if I understood it correctly, you encapsulated, incorporated, and embraced this relationship between GDP and then market cap and then weighting, which all ties back to the source of revenue of those companies regionally, where they traded, where they're based, and then also beyond that, where the actual revenue comes from cross geography. And it seemed the question is, were you saying, do you now believe that in an asset allocation, regardless of where it lies in the cap structure, private or public, that one should regard that, incorporate that, and act on that, and own assets outside of US, more outside of US, as opposed to the US exceptionalism? Because a couple of weeks ago, if I'm not mistaken, you were saying that the money would flow back into the US, which to your credit is what happened, or is what's happening in super quick time. But at the same time now you're saying are you saying, here's the question, are you saying one should now seriously regard ex-US and incorporate that?
What I've been saying all along is don't go chasing what's going on because the other areas put stimulus programs together and everyone was jumping on the bandwagon. I think you have to be more balanced. I think there was people's portfolios were too heavily weighted to the US and then they were going to swing too far the other way. And I think you have to be more balanced about what you're doing. I just want to clarify, I was only giving perspective. I was not encouraging the market cap versus GDP discussion. I was giving perspective for it. I wasn't saying tie the two together. I want to be clear on that. I think you go into markets looking at the markets overall and figuring out what the best risk rewards are. But I don't think you have to be everywhere, but I think you have to be better diversified than a lot of portfolios are today.
A lot of people, Stephen, do tie it together, though, as you know. They say because the GDP is, but when you saw, for example, China at 16, it's doubtful if you're not already a China bull or embrace that you're going to shift 16% of your assets to China, let alone for those non-believers, So thanks for clarifying that. Personally, as you know, I'm a global investor. I think it's all connected, and I think that's the way to do it. But that's my own thing. Thank you.
I think you can be a global investor in a lot of different ways, though. And I think that's what makes it such a sporting event to be an investor in this world. But there are a lot of different ways you can get there. You can get there with 40% of the US, 50% of the US earnings are global. So it just depends on how you want to slice your pie.
Michae Hammer?
I'm going to start with, we live in interesting times, which I usually say at the end of my comments. So, the truce between the US and China, I'm not sure how much reality there is there. I mean, because we were down to 0 sailings from China. It takes time to production that was stopped to restart, to get the ships loaded, to get them sailing. So in the short term, I'm not sure how much real impact there is from this truce, other than maybe a cooling of the tensions. The US agreed to a deal for short-term political reasons. China agreed to a deal for long-term reasons. And really, those are still outstanding. And I don't see China being soft in the negotiations. They have every reason to push back. In other news, Stephen, you mentioned the S&P 500 and where it's going to be. Our high so far this year was 6,100 roughly. So getting to 6,500 isn't that great of an achievement compared to where we were, people saying at the start of the year. And the other thing I'll note about the S&P, I was reading that Coinbase is going to be joining it. Yeah. That's an interesting twist to me. So I don't see that the calculus has changed significantly. It's just that potential changes in the environment are there. How real are they? I have no clue.
I agree with you, Michael, except on China. I think that, and the US, I think it is short-term pain is being felt by both already. I think that there were factories that were either cutting shifts or closing down, that it was being felt in China as well. And so I think the pain has been real in all over the world. And I think the ship numbers that you talked about were the fear that everyone had. And as much as Trump said kids could have two president dolls instead of 30, I think that's a sign that there was concern here as well. So I think there were real issues that got them back to the table, economic ones, not just political, that they were feeling the pain already. And you're seeing it here with shifts being cut in auto factories in Canada, all around the world, the pain was being felt. So I think people needed to dial it down, the rhetoric. I don't think that China, I think they're playing it quite well. So don't confuse this as they buckled. But I think it was in both countries' best interest to move down from what even China labeled as a joke. At these levels, there was no commerce going to be done. And getting it down to more reasonable levels will allow commerce to move again. And that eases the pressure on the whole system. So I do think there was real pain that caused this to move, even though it was short.
Well, I agree that there was real pain, but I think China was in a better position to deal with the pain than the US. And I also think that having seats at the table to talk does not equal a deal. And I think the Chinese have every reason to take a stronger stance than the US will be willing to do.
Yeah, the last slide I put up with the deal or no deal is because I think there's a high probability that deals will be so watered down that it'll be the equivalent of not really having deals, but there will be capital flowing into the US. So it won't be the grand bargain and all that, but people are moving. So
one of the things is, just like the deal announced with the UK, the devil's always in the details, right? And the administration really, really wants to announce deals, progress, whatever, and they're willing to stretch the truth a bit.
All right, both sides do that. Jonathan Clark.
Thank you, Mark. Stephen, awesome presentation as always. I really appreciate you. Big, beautiful bill question. There is opportunity zones in the Trump tax cut extensions. Do you have any feel for whether these are going to continue to be in the bill? And do you have any idea if this bill is gonna get reconciled and signed?
no to both questions is the answer. I have no insights on either one, but I think, Mark, is Greg on the call from Exemplar? I thought I saw him earlier.
Oh, look. Keep going.
Or are there any other tax people on the call that might have an insight into this?
Any Washington, D.C. insiders?
I think, Jonathan, the one thing that I'm really interested to see what they do is on the tax credits for new plants and how they're handling incenting creating new factories and stuff here. I think that's a big one. If they get that through, I think that really supports the infrastructure and the reshoring initiative in a big way. So that'll be interesting to see.
I've got one, if I could comment.
Thanks.
Yes, Joe.
Go ahead, Joe.
Some of you have heard me blather on about it, an overlooked tax incentive that's available for early stage venture investors that allows for losses to be deducted against ordinary income and a write-off that's better than a charitable contribution. It's called QSBS under Section 1244. And it's been around since 1958. And in 1978, the levels and limits were indexed to inflation, but they've been overlooked ever since. Most people don't even know they exist. And
Are they being touched, Joe?
yes, I've been a one-man lobbying band for almost 20 years, and the position paper I wrote years ago is in the hands of the tax advisor to the Ways and Means Committee, and in the hands of one of the congressmen that is on the committee, who's advocating for liberalizing QSBS, the more modern one called QSBS under 1202, which allows for profits to be tax-free. So I think for the first time, we've got likelihood of 1244 finally getting just indexed again to inflation like they did back in 78. But that would mean that instead of the first $1 million that goes into a C Corp, a qualified transaction, which is very easy. Right now, the law says under 1978 dollars, the first $1 million of investors in a deal and the deal fails, they can write off their losses against taxable income. That would go to 5 million. And the amount you could write off of 1244 deductions would go from $100,000 a year up to $500,000 a year. So just doing again what they did in 78 would have a profound impact on investors and startups.
That is pretty big. Greg
Yes.
Wilder, I saw you just joined. I'm wondering if someone told you to join.
No, I was on earlier. I had to jump off for a 15-minute call, so sorry.
The question, Stephen Burke, you want to restate it?
It was my questions.
Or you want to reiterate it?
Was that Jonathan who asked the question?
Yeah, it was. It was about the big, beautiful bill and the opportunity zones.
Do you think that they'll keep the opportunity zones in the bill, Greg?
Well, the one they marked up 2 days ago, they're actually starting their actual drafts and markups today. I was going to say this on the last call, and it's probably going to be premature, in my opinion, to talk about it in 2 weeks or 3 weeks. I guess it is out in San Francisco on the West Coast, but I fully expect we'll have a bill. Their goal is to get it by Labor Day, and we'll have something signed in June. So it'd be a great topic for Rhode Island in July. But yeah, they already have talked about expanding opportunity zones and extending them and making parts of it permanent. And it's still in markup. It hadn't even gone to formal markup yet. It was just the drafts from the committees, and they've outlined, if you will, what they're going to do. But there will be something, I think, passed between now and the end of June, if not sooner.
Thank you, Greg. That's actually music to my ears. I got a deal right now, so I appreciate that.
And a lot of it's retroactive, which is interesting. A lot of this stuff's going to be retroactive back to January. Like there's some huge things in there to allow immediate expensing of manufacturing facilities, like the whole facility, real estate. There'll be some big things to try to encourage development in the U.S. of manufacturing facilities, even beyond what they had in bonus depreciation back in 2017. I was just reading some of the highlights yesterday, and I don't get too excited until it actually ends up in a bill format, but it's getting there.
So I'm glad you mentioned this. Everybody knows, yeah, other than Seattle and San Francisco, Newport and the Hamptons are also online. And then we have a very busy fall, as you can see, from London, Singapore, Mumbai, New York, Riyadh, New York.
Yeah, I was going to say, Mark, if there's anything, highlights or anything does happen in the next 3 weeks, we can certainly carve out a little time in the panels to talk about some of the highlights. But I think it may warrant going in depth in July, because I fully expect we'll have something by the end of June.
Yep. Okay. Who else? We had someone else.
Leslie.
Leslie. Leslie? Yeah.
Sorry, I just had issues with my mute button. Thank you once again for your excellent presentation. I had, with the expectation, or I should say lower expectations of a recession, I'm wondering how your views on energy and energy pricing factor into that, particularly in light of the activities in Riyadh with 361's delegation there.
Mark, do you want to start from the Riyadh perspective, and I'll talk about what our take is on what's going on?
I think well, first of all, America's definitely benefiting by the Saudis' position on oil. I don't think it was directed for that, or maybe it was. I don't know the politics behind it exactly, but I'm hearing, long transition. And did you guys see what Altman talked in the U.S. testimony? It's all about energy cost, right? Access and energy. So it's a huge factor. I don't know if you wanted to add on to that, Stephen.
Yeah, I would just say, Leslie, I think I think we're gonna, I don't think the US oil companies will react by pumping more. I think they're going to work for maximum profitability. I think the Saudis really wanted to knock out the cheaters and make sure that other people get in line, and they haven't been. So I think that it's going to put a lot of strain on the system. I think one of the countries that gets hurt worse by this is Russia. So I think we're going to see, and I also think this is a reflection of just the cumulative effects of having both fossil fuels and renewables building up over the last several years. I think you're now at a place where supplies are getting pretty plentiful of a lot of stuff right now, and we just have to, the system's trying to figure out how to use it all. So I think that there is reason for oil energy prices to be down. I would say I think they're going to probably be lower than people would like, as low as people would like for a longer period of time. But I think that some of this is political, and we could see a bounce pretty quickly up in prices with some geopolitical event. So, Michael, you're in the space, so do you have a view, Michael Hammer?
Yep, that's why I raised my hand. And my focus is the Utica and to some extent the Marcellus, which is a little bit different than what goes on in the Permian and out west. Right now, EOG, Enron Oil and Gas, is starting to drill down below the Marcellus and Utica to the Trenton Black River. So Utica and Marcellus are shale plays. Trenton Black River is pools, like traditional drilling. They can extend the existing wells down, and they're looking at using carbon capture and sequestration to increase the pressures and flow of the oil. So you're going to see it continue. There's a lot of demand for employees in the area and not enough people to fill them. But there is concern about what's going on globally, Saudi Arabia, etc. However, natural gas is a little bit different. You're going to see increased production of natural gas and natural gas liquids, and you're going to see more exports going ahead. So drill baby drill is in conflict with what's going on with Trump encouraging the Saudis and pumping more. That hurts. But on the natural gas side, prospects are rosier. At our lows this year, we were down below $2. Right now, we're about $3.60. The high this year was a little bit over $4. And I think for the time being, apart from geopolitical events, you'll see it stay in that $3.50 to $4 range for the near-term future.
Michael, can you speak at all to the export factor in some of the facilities that enable that? Do you have insight?
Yeah, so historically, natural gas exports were less than 10% of U.S. production. In recent times, it's been more like 25%. And with the proposed, well, export facilities under construction plus ones that are recently permitted or about to be permitted, we're going to see that higher, which means U.S. consumers, both individual and commercial consumers, are going to be more subject to fluctuations in global markets.
Fair enough. Okay, Rob, you had your hand up for a while.
Thanks. Yeah, just one comment on the op zone and then something else that I think Steve brought up. Just on the op zone side, I was in Washington last week, and I am seeing bipartisan support for this. The real interesting thing going on is that the developers are smart. They're presenting cases that they're not displacing sort of residents, which is a clever position because you have win-win for the residents, but then also some of the tax exemption that's brought to that. So I have a good degree of confidence that's going to pass with all the bells and whistles to be determined, but it's going to pass. The other quick observation, Steve brought up Altman's name. I thought that's very interesting because he and Musk have been sort of at war over the last 6 months, and the fact that he's been allowed, podium time with the president and Larry Ellison from Oracle, I think either shows his rise in power or Elon's acceptance of neutrality. So I just want to throw that out, Steve, to you and see if you have any insights to that. And then thirdly, there's an energy link I might put in the web here. There's a Capitol Hill related forum and reception on this over the next couple of days. But Steve, on the Altman side, I was curious if you had any insight.
I do not. I don't follow the back and forth between those two like the rest of the crowd does. I'm struggling with the rest of the world right now. So I'll leave the AI stuff to Sam and Alon. No,
and then there's one other name in there, which is SoftBank. I think Masayoshi Son was up there with SoftBank. So even though there's strong connectivity amongst, there's some neutrality going on. Thank you.
Well, I think Altman raised so much money from the Saudis that the Saudis want to see their boy up on the stage. So that's my
Yep.
point of view.
I think this is payback. Yep.
Giovanni?
To the comment about energy, the word, I got my ear to the ground on energy, at least in Texas and New Mexico and so on and so forth. And I would say there is a general consensus amongst operators that Saudi Arabia is out to get America. The consensus is that they believe that America has become sort of energy independent at the expense of Saudi Arabia, cutting back its production, and that the belief, maybe Michael can speak to this, the belief is that oil production in America is not profitable at sort of 60, maybe even $70 a barrel, and that Saudi Arabia and OPEC plus countries, including Russia, literally want to drive oil to below $60, $70 a barrel, and so that it hurts Trump, because Trump wants to sort of lower oil prices, but it'll affect the oil and gas industry. So what I'm hearing is that oil and gas, rig counts are down. Oil production in America is already sort of starting to come down. New wells being drilled has fallen off sharply. Yes, natural gas has gone up in price, but that's a regional market in a way that oil is not. So I would say that that's what I'm feeling, and I heard something else from Michael. So I don't know. I'm just passing on what I'm hearing, with my ear to the ground on oil.
So, like I said, I'm focused on the Utica because that's where my interests are, and I keep my ear to the ground, and I know lots of people on the production side. But I disagree with you. Natural gas is no longer a regional market. You've got major pipelines, for example, going from the Midwest down to the Gulf Coast, the Nexus and Rover pipelines. And it really has become more of an international market. That's why when Russia first invaded Ukraine, natural gas spiked to $9, right? And
right,
if you were getting royalty checks, it was amazing.
Michael, can you speak to what are the lifting costs by basin? You starting with Utica.
So Utica, it's kind of strange because the main driver has been the natural gas. The oil is the byproduct. In the Permian out west, for example, natural gas is the byproduct and oil is the revenue driver. Up until changes in regulations, they would just flare off the natural gas because they didn't have ways of transporting it. Oil you can do in trucks, you can do by tanker. Natural gas, for it to be effective, it has to be pipeline. So that's a big difference. As far as lifting costs, you know, even at $2 gas, it works for the producers. They're not necessarily happy about it. And like I mentioned, they're starting to drill here down to the Trenton Black River. The incremental cost of getting down to that, all the facilities are there, the pads are there, the boreholes are there. All they have to do is go 3,000-4,000 feet further down to get at that oil. And that's pooled oil, so it's easier than fracking and doing the vertical runs that they have to do.
Okay.
Michael, my understanding is that the 60 to 70 break-even prices come down considerably from then, and that the top producers are down in the 40 and 50 range now. Are you hearing that?
I would agree with that. I know that the vertical drilling, the legs, they become much more efficient. So drill plan that might have cost 25 million for a well, including the multiple boreholes on the pad. That 25 million today is more like 12, 13 million. And the legs are much longer, so they can do spacing of the wells farther apart.
Yeah, and I would also just caution people looking at our rig counts and stuff. I would look at them differently than we did 15 years ago, because today the oil companies don't get paid for producing barrels of oil. They get paid for being profitable. That's how the street values them, is on their profitability, not on their production. So I think some of those changes that you're looking at of the numbers, if you looked at them the way you used to look at them, you would get a different message. I think these companies are very healthy. They're just really trying to focus on their profitability now, not on producing just to produce. I think that's a big change.
The other thing to understand is the rigs are much more efficient in drilling in today compared to before. So you can get the same amount of drilling done with less rigs.
Right. That's a good point. Any other comments? Could be unrelated to what we've talked about.
Mark, I want to thank Giovanni for not knowing if I was a liberal or conservative. I think that means I've done my job for 266 weeks. If they have people confused on that, then it's worked.
It's awesome. Well done.
I'm actually a free market guy, Giovanni, and I'm an anti-political person. I don't like people in politics. If that helps you.
By the way, that was a refrain. Some of the politicians we've met lately, they love saying, "I'm not a politician."
Hey, Steve, just quick question. It's Rob. With regard to the Qatar gift of the Air Force One, that is, that's interesting. I mean, I'm sure they worked through the White House thought through the legal areas there. Any Mark or Steve, do you have any insight to that?
I think there are things you can do and there are things you should do. I don't know if you can do this, but I don't think you should do it.
I'm just wondering where the bugs are throughout that plane.
Where aren't they?
Yes.
Well, I'm sure there's going to be a full sweep of it, but the Trump's benefit, if it costs the U.S. nothing in terms of taxpayer, and then secondly, it's a 40-year-old plane. You have an advanced, more modern design and technology. I'm just thinking out loud that
But Rob, isn't the question what is Qatar getting for their 400 million?
Not really, Roger, but I think some of it is as a goodwill investment. That's a small amount compared to the larger stake here if you look at World Cup. But do you have some insight?
I just think the optics are terrible for the
Yeah,
president of the United States. It's that simple.
not for the president, it's for the presidency, the institution of the United States. Forget Trump as an individual.
Yeah,
I think
I didn't mean
that
him. I meant the
president is
office.
ridiculous.
We
Yeah.
have some hands up. Maher, you want to go?
Hello, everybody. I can answer that question for you,
Oh,
bro.
okay.
So, because I'm into politics, from Middle East. So you can see now is like, what do you say? During the Trump visit, he's collecting a lot of, we call it deal. If you notice that all the CEOs, major companies are with him, visiting 3 major countries in GCC. So what the Arab's agenda is, like, try to stimulate to have a fair deal as a foreign policy by offering, we call it a gift. And that gift was for Ministry of Defense of USA. It's not personal. So that is like, I feel it's a fair deal. But hopefully the question is whether is the foreign policy will be pick it up and this time and acting as diplomacy is like, moving forward with Middle East with a fair diplomacy, I call it.
Okay.
When you see Trump getting attacked from both the right and the left, right? So on the right, Laura Loomis is really, going at it about this.
Mhm.
It's really a non-starter. Even if it happens, it's going to create a lot of political ill will across the spectrum.
Let's keep going. Samir?
Yeah, so just a question on that, just to finish up.
Okay.
Wasn't it the case that the plane was supposed to go to his personal presidential library after his term? Is there any truth to that?
Correct. So it's not DOD, it's to him personally.
So
All
I
right.
would have an
All
issue
right.
with that.
Anything else we want to talk about?
Anyone have a topic for next week?
Yeah, let's run a poll. What do we want to talk about next week?
You can't plan ahead. They're going to find out that Sunday night an announcement comes out from.
No, it's not Sunday night. Oh, you get an announcement. I get it from you
Yeah.
like Monday at 10. But
How about the changes happening in the venture industry?
we're going to talk about that, both San Francisco, Palo Alto, and Seattle.
May I
Mark,
suggest?
can I ask a quick question too?
Or you can make a suggestion.
No, I'm curious if anyone else has views on the IPO markets. There's been a big bounce obviously in the indexes. Just want to see if anyone had thoughts on IPOs, for the coming quarters.
We have 2 clients doing them. But they're doing them for different reasons. I don't know. Anyone else?
Yeah,
Joe?
there's been ample discussion about why, given the market's elevated levels over the last year or two, why there hasn't been more. That's always been highly correlated, and the conclusions and observations seem to be that the silly funding rounds that were done are priced at the last round at such a level that going public and the disciplines of the public markets would probably collapse their valuation, and the VCs are holding back because they don't want to mark it down for their own returns, their own selfish agenda.
How long does that go, Joe? How long can that?
How long?
Yeah.
I can't predict the future, buddy. I think that rationalization is the rationalization of valuation. I mean, the disciplines of the public market is important. However much the people claim that there's costs involved and all that sort of stuff, that discipline is important. And I think that the way that the industry has been funding things at such exorbitant prices and with very little corporate governance involved, we've seen the headlines in many of those companies. I have no idea. Maybe that we'll start seeing a flood of deals that aren't the late stage silly funded things, and companies get back to using the public markets for what they were intended for, which is actually a source of capital, not a place to dump off overvalued securities into ostensibly retail hands. The mutual funds and everybody else that I saw this back in the 90s where they were the the public market portfolio managers were in cahoots with the venture capital industry to dump off this stuff and let it get buried in the broader performance of a mutual fund or something else because of the valuation. So I think that gig is up. So I don't know, to be honest with you. I think the rise of the secondary markets in the private markets is an interesting reaction to it, but it's almost like a pressure valve relief than it is, I think, a long-term solution per se. I think the discipline of the public markets are still important.
But Joe, given the discounts in the secondary markets, it makes me feel like it's almost the weak hands are being washed out, right? You're going into the secondaries because you need the money. And the discounts are substantial. I have one, at least for me, significant holding. It's up into the 7 figures, basically into it. And I looked at the secondary market and I decided I'm not willing to take that haircut at this point. The other question is for, larger startups, and I'm not sure when a company stops being a startup.
Right. Private company. Yeah.
But if they're marginally profitable or at about the profitable line, they can wait. But if you're a large company consuming lots of cash, are you going to be able to do another round?
That's the question.
Right. So there's those sorts of factors that I think are going to play out.
Just
Joe, it's Rob. Just quick thought on secondaries and venture. I guess there's word that some of these college endowments are really looking at secondaries because of the volatility associated with, let's just say, the Washington administration on some of the tax exempt status. So most notably is Harvard. In that, let's just say that Mark, that's an interesting topic for dialogue and research by you all. But the word is there's venture secondaries going on from these schools, and are the prices justified to what their ask price? And there's mixed reviews of yes, and some want to wait. Joe, what are you thinking on that?
Harvard's an interesting case because I saw somebody do an interesting and I think thoughtful write-up on it. One of the things to understand about Harvard is they also have like $8 billion of debt they floated in the recent past. And with the pressures of coming on them, whether it can become a taxable institution or not, the backdrop that Trump's imposing says that they may be having a serious liquidity crisis because of the amount of debt they've taken on, which in and of itself was patently absurd. So yeah, they're offloading a big chunk of their private equity and their alts stuff for reasons I think that aren't necessarily just taking advantage of the secondary market. I think there's a lot of other cross currents of reasoning with Harvard in particular. I haven't seen write-ups of any of the other institutions. I also saw a statistic that some god-awful number, like 40 or 50% of the secondaries that are taking place are also in glamour names. So the industry that sprung up, the secondary industry that sprung up, the SpaceXs of the world and some of the OpenAIs and some of these others, a lot of that secondary is glamour names that are being pushed by these firms that have become brokers of secondary issues for them to have a shiny object to sell into investors. So it's not a deep market. While the numbers are bigger than they've ever been, that's coming off of such a low base. It kind of is noise from a signaling standpoint. And when you look at the actual marketplace itself and what's being done, it's still pretty thin. And it's pretty concentrated in a few names. So I'm always skeptical of Wall Street touting anything new because of they're selling a new shiny object and they get transaction fees as what's driving their hype machine. There needs to be a secondary market, and there's lots of folks building the plumbing and actual like NASDAQ equivalent. So you actually have bid and asks, you have a more liquid and efficient market, more price discovery and that sort of stuff versus this dark secondary market as it stands today. Yeah. But yeah, I think it's an interesting development, but it's more a symptom than a cure, I think, of the lack of health in so much of the venture capital dollars that have been allocated. And now these companies can't go public because of the valuations. That's the underlying problem. Otherwise, there have been a lot more IPOs given the backdrop of the public markets. I heard a public market investor talking about this, screaming about it. Look, said we'd love to see some IPOs, but they have to be thoughtful and reasonably valued, obviously, to make sense to even buy as a public market investor. But nothing's coming public in a sense because of the valuations that was done in the last venture rounds. They just can't go. The VCs won't let them go public because it'll be you're now marking to market something that could be 40 to 60% cheaper than what they funded it at. And they don't want to take that hit to their portfolio because they were already also writing such big checks to elevate those prices.
Right. The VC emperor's clothes. All right. So Meyer, Samir, and William, you have your hand up, or Bill.
So yeah. So 3 points. One with Joe, totally agree. Right. Fundamentals. Right. Startup fundamentals are weak because there's so much uncertainty. And valuations are like way overblown. There's way too much money chasing, too few quality deals. So yeah, total overvaluation. There's going to be a correction. Good hypothesis. Second point number two, to Michael's point earlier, right? What is a non-startup, right? When does a company stop being a startup? I feel it's when they can consistently raise money with a lot less friction, right? So the definition of a startup for me is how much friction does it take to raise money from either equity or debt capital markets. Once you kind of pass that threshold, then okay, you could consider yourself, not that, regardless of whether you're private or public. Number three, Mark, maybe one topic for future discussion, right, is U.S. manufacturing. So right, so with all the hype and all the let's say money that's available, right, as well as both within the U.S. as well as outside, with some of the incentives that are potentially coming up for U.S. manufacturing, maybe have a session on where that's going.
Okay. Fair enough. Maher?
Yeah, as a suggestion, as a topic for maybe see the analysis of the startup and SMEs in the US market industry-wise. I think that can be give insight about what the forecast is moving on, for the next couple of years. Thank you.
Mark, I had trouble hearing that one. Could you just repeat what it was? I didn't hear the.
I think you want to just repeat it, Maher?
Yeah, I said as a suggestion, just to see the forecast of SMEs and startups in the US market and the forecast for the next coming 2 years, but industry-wise. You have a tech industry, logistics, a lot of I consider vital line of the businesses. Those are like is a good to get insight and get segmental economic segments to see where things are heading in the couple of years. Thank you.
And Bill.
Yeah. I just wanted to follow on Joe's point just for a second. So about a month and a half ago, I was at a gathering with 300 other allocators, and one of the panels was on continuations and secondary funds. I was pretty amazed. The sponsor of the gathering was a very large consulting firm, and their head of private investments was talking about essentially taking the money and run if you're an investor. And I was stunned by that. Obviously the lack of liquidity is fostering these kinds of vehicles, but the fact that they were advising their clients to go ahead and take liquidity when they could, regardless of the discount, was also a very interesting sign. Not a good one, but an interesting one.
Bill, I have a question for you and Joe on if the endowments are getting the light shed on them like they are right now, do you think that will lead to significant changes in their asset allocation?
I'll go first. I'll leave it to you, Joe. But I'm not sure how much change at their strategic allocation level, because quote unquote PE has been good for a long time. Now it hasn't. Whether or not they will make a definitive change, part of the question is, if you do, let's just say, we're gonna cut back our PE allocation by 5 or 10% percentage points, put it that way. Then where are you going to put that money? What's the next best alternative for it? And I think that is a tough question, for them because there's so much momentum in the past. And I also think there's a lot of hope going forward. People are still talking about the potential of, 2004, 2005 vintages just because PE is so lousy right now that maybe those might be very good vintages, to get into. But then, people don't have liquidity. So it's a really difficult, if you're
So
running.
they can borrow money to take on the new private equity allocation to pay for the last one.
Yeah, it's so true. Let's do a little NAV loan. Yeah. No, I think there are a lot of banana peels out there for sure. So we'll see how it all gets navigated. But it's if I had a big PE book in my pension portfolio, I would probably be concerned at the moment. As it is, we have a little one.
Yeah,
So
PE is a broad definition, whether you throw venture in there or not. So it's very difficult to generalize. There are those institutional investors that got over allocated to alts. There was some perverse incentive in there because they didn't have mark to market. They didn't have those sorts of things. So part of that money was allocated to hide. Part of it was they were sold a bill of goods by the consultants. A real problem with the pension plans and the endowments that have a fiduciary or an actuarial required distribution, think foundations, if you will, is the liquidity, the capital calls, right? They've been backing away because of the intermittent cash flow requirements. They may commit $100 million to call it a venture or private equity, whatever, but the money is called in as the decisions are made. And that really throws their cash flow at the institution level. If you're a pension plan, you've got a required rate of return. Otherwise, the municipality has to make up with real cash the difference. And so some of the internal dynamics and logistics of the institution will have a major impact on that also from their own cash flow and the capital calls. And again, given the lack of money coming back in, i.e. liquidity or exits, and yet, do they want to allocate more where there's going to be more of a cash crunch? The answer is I'm guessing they're backing away. And it's not an accident that the Apollos and the others are reaching out and working with like State Street and others to try and grab retail dollars into these alts asset class. That's always a dangerous, dangerous sign. That's a signal, folks. You can't deny that signal. And when they're going retail, that is sort of the beginning of the end, or the evidence of the beginning of the end for that asset class. So ultimately, the question is, and this is where the big institutions are in a pickle, because the public markets, what are they going to do? What are the nominal returns from here going to be in the public markets when you've got what's going on in the dynamics of the public markets? We don't have the tailwind of falling interest rates to elevate PE multiples or cap rates or whatever you want to call it. So this is the $64,000 question. This is why there's also a mad scramble to try and figure out how to invest better and treat early stage venture as a real asset class. So you could allocate serious money and have confidence there. It's going to be some repeatable alpha delivered by early stage because it's the least financialized. It's the last asset class that hasn't been distorted due to all the money splashing around. You look at the venture flows, it's all late stage. Angel or early stage investing, seed A and B round has just been absolutely flatlined for almost a decade. And yet we've had this massive explosion of dollars going into venture. Well, it's all become late stage. It's all been a lot of the stuff that we've all read about. So if you're an allocator, you're in a conundrum. If you're under allocated to alts, you're in the catbird seat. Mm-hmm. That's a fact. And I think that those are going to be the opportunistic investors that get really smart. You're going to see some of the quiet money that hasn't been the asset class in any large way start really showing up. And it may be nibbling in and around the secondaries because of the discounts, buying up partnership interests at a discount, not just individual holdings, but partnership interests at a discount. That's where I think you're going to see the real thoughtful money start allocating. And what institutions do that, they also are also bloody different. If you understand institutional investors, they don't move in a herd per se, because of the role of the consultants and the nature of the funds and that sort of stuff. They look like they might move in mass, but they really don't. They're as quirky as family offices in many ways.
The other thing that happened, Joe, with the endowments is you may see the universities start more fully outsourcing as they look to cut costs again. So they'll have that debate of in-house versus external
Oh, yeah.
management all over again. And, we'll go through that whole expensive change that they make.
Steve, the one thing that you haven't brought up or Joe didn't bring up is a lot of this is governance related. Meaning, let's say if Harvard, for example, did accept all the terms, at least they could know what they're dealing with. It's kind of like the law firms that were targeted. Some of them reached settlement, but some of them are having these debates of it's better in our position to hold our ground or to string this out, wait till after midterms or wait till after sort of the next cycle, and then reposition. So, I mean, this point on the private equity, if you're able to be patient and willing to take that type of duration, they may come out winners because they may actually not fold and have alpha kick in mid to later term on the investment. I'm just bringing it up from a governance side. You're shaking your head, yes.
Well, I think the politics are going to play into this in a bigger way than people would like. So I think there'll be bigger changes coming. Whether they're right or wrong isn't the issue. I just think there are bigger changes coming, something to keep an eye on.
We're coming up on an hour and a half, guys.
Stephen, this is Greg. Just to reemphasize what you're talking about, I do think it will change things dramatically if the proposed tax bill goes through, because they're talking about raising the current interest rate on endowments and universities on their investment income from 1.4% to 21% on and foundations to 10%, universities to 21%. That's a game changer. That's the same as a corporate rate. So they're really talking about taxing them as corporations. So I think it totally changes how they would invest if that becomes law, but let's see.
Yep. Yep.
And that was in the markup that came in this weekend.
Well, maybe we should, Stephen, talk about this beautiful big bill.
That would be a good topic. Greg, is the carry in or out?
Right now it's out. Trump wants it in, but it's out right now. So just like the salt, they can't agree on anything. So only time will tell.
But
You mean, is it out? When you say is it out, they're proposing no changes to it right now.
Okay, because at one point, like you said, Trump wants it in.
Yeah, he wants them to change that, but right now it's not in the bill, and that's one of the things they're having disagreements on.
But I just wanted to piggyback on Joe's comments about PE and funds. In the venture space, it's interesting to me, Joe, you said looking at earlier stage, it can't digest that much money. We saw that with Sun force feeding startups. It just didn't work very well. But a significant portion of dollars invested in the VC space is going to AI, and other areas are starving. But when you're talking about seed A rounds, they can't digest that much money. And the deals that I've looked at where they are taking a lot of money, the economics make no sense to me. It's setting the stage for future down rounds, if you will, or people trying to game the system.
Okay. Well, Giovanni, sorry, you got your hand up still.
Can you hear me?
Yes.
Yep.
Okay. So I'm a bit of a contrarian by accident. I don't wish to be obtuse. I'm
Contrarian by accident. Okay, I'm just trying to weigh those words.
Okay. I didn't fall into the VC PE trap. One of the reasons was because, I thought that when you had low interest rates, I was concerned about it. And then when interest rates almost tripled in the last 4 years, I thought that we'd see, capital dry up and that there would be down rounds and cram downs. about 3 years ago. Yeah, 3 years ago, I was at the Milken conference and I saw like my sentiment, my thesis was like on PowerPoint slides at one of the panels. It just never happened the same way as rising interest rates did not seem to crash the real estate market. So and I was interested in PE and venture capital, but after a cram down, after a down round, if I want to get some exposure, when I think that there is too many startups in similar areas and there's going to be consolidation and so on and so forth, in your opinion, how do I play, being in the secondaries or whatever, not, you said those people who avoided the first round of VCPE, they're in the catbird seat. Now that I'm accidentally in the catbird seat, how would you play my hand or whatever?
I think that was Joe, right?
Or Joe?
Yes.
Yeah, if you're
Joe,
an
you're on mute.
allocator, again, I mean, investing is, as Steve said, is such a fascinating thing. And for those that you don't recall, I used to run a multifamily office, and we were very good at managing risk because we're willing to sit on large piles of cash. And if you don't go down as much, you don't have to go up as much. And I look at the signals that Buffett's been sending and others that the smart money, and I say smart, that's such an arrogant statement. Those folks that play a longer game and don't respond to all the shiny objects that's thrown at you as an investor by the financial services industry, you're getting paid well to sit on cash. And the one thing that also empowers you to do, which is overlooked, is when everybody else is losing their minds because they over allocated, now they're dumping stuff like we're seeing the alts and the institutions we were discussing. That's where the opportunities start really rising. So the old adage of buy low, sell high is you've got to remain disciplined. You have to remain patient and be comfortable not swinging at the pitches that Wall Street throws at you, or the financial services and the PE world and venture world, et cetera. Stay away from the hype. And so if you're away from that and you're liquid, and you've got cash balances, you get to play offense when others are playing defense. And that is the single best thing to do in this environment. So I think that the public markets I've gotten out of because I can't figure them out. I mean, the Mag 7-ish sort of, or the FANGs or whatever else you want to call it, has just distorted that marketplace so much. It's damned hard to be a thoughtful investor in that world. There's plenty of trades, but that's different than investing. And I think venture has shown up to be the same thing. There is so much hype around venture and FOMO investing. So I guess my broadest saying is just check your own liquidity, check your own need to deliver a specific rate of return, like the institutions do. They have a actuarially required return that they have to try and hit. So they're forced to stay fully invested and simply manage beta as they're capturing the nominal returns.
Joe, just to put a lot of like say actual trades happening, probably one of our most active discussions was our secondaries panel last year in Silicon Valley. We didn't record it very well, but it was people chiming in on one trade from 5 different angles. Like I saw it here, I saw it then, and then they compared notes in the hallway, because it is like a cubist painting. But I really think you need to be with us in Silicon Valley. I was just on the phone with Anurag Chandra, who's putting that panel together again. You know Anurag? I don't know. It was.
Oh, he and I've had a lot of good chats. Actually,
he was great last year, Mark.
Yeah. So, but I actually thinking I may want to play. I want to get into that dialogue that we had as the panel was ending. The dialogue sort of started, and I think that I'd like to make that the panel.
Well, just nudge them and say, hey, look I'm happy to. I mean, like I said, as I put in the chat box, I've recently been added to a new journal getting launched called the Journal of Private Markets Investing as sort of the venture expert. I'm on the editorial review board, and we'll both continue to write papers that get published, but also filter those papers that actually get submitted and eventually published on the venture asset class. So this is an area I've studied a long time, and
course.
I think that
You know what
there's
I
a great
also,
opportunity.
I also
There-
liked seeing you in Austin and the guest you brought. That was an interesting
yeah.
discussion we had. All right,
Yeah.
guys, I have to go. So I need
Me
to,
too.
I think we all have to go, but this is great as usual.
Fun stuff.
Thanks, Joe. Thanks, Bill. Thanks, everyone. Giovanni.
Thank you,
Appreciate
Steven.
your
Thank you,
Thank you
Steve.
very
We'll
much.
talk later.